Okay, so let's calculate the expected return given the level of risk. So we're going to calculate, it's going to be the risk-free rate. So as decimals, that's going to be the same for both. The difference is only in the betas. This one is 0.8 and this one is 1.2. And the market risk premium for both is, of course, the same. So the only thing that varies is the beta. Okay, you're going to use the line. And this is going to map us to the expected return for both. This one is going to give you 12%, and the other one is going to give you 16%. If you want, you can plot those or visualize those here, and A will be on this side of the security market line. It's because it's beta is less than 1, and the other one, B, will be on this side. So I could actually plot those sort of evenly. So this is going to be A, or I think it was lowercase a, and this is B. And now let's talk about creating an asset that combines A and B. We'll call it P, and P is going to be just between them. Okay, so this is a result of taking assets on the line and weighing them will just result in something in between them. Okay, so that it's going to be somewhere between the lower risk, lower return and the higher risk, higher return asset. And it turns out it's going to be, well, if we find the beta, we're going to see if it's below M or above M. So let's see. So here's the information. We're going to create a portfolio P, 60% in A and 40% in B. Because there's more A than B, it's going to be closer to A on the security market line. We could calculate both the expected return and the beta as a weighted average. Okay, so this is a weighted average of them. And you get 13.6. You can check all these numbers later, or if you haven't already. And this is also, the beta is also a weighted beta. So this is the weighted average of betas. So it turns out that it's just under the market portfolio with this expected return. So P is going to be like over here somewhere. Right? And it's going to have a beta of 0.96 and an expected return of 13.6. Okay. Also, it's important to note that you could have used the line itself, again, just like you did here, to map risk to return. I could get the weighted beta, 0.96, and plug it into the capital asset pricing model. So that's another way to get the answer. Okay. So, as I explained, yeah, there's several assumptions, and you have to, you'll see in the problems, it'll say the capital asset pricing model holds, and then you can use the line to estimate returns or measures of risk. So that's that. And now we have the cost of equity. So we started this last class. And we talked about estimating for the UAIR case, part 2. Given all that information, we were able to get through here estimating with the capital asset pricing model the required rate of return for UAIR. Oops. And we ended up here. We decided if we were going to use the initial calculation that was with using the last 6 years for estimating the T-bill rate and the average historical market risk premium, we get 5.27, and it indicates we should invest. And like all the assets that are undervalued, we should buy and hold them. In other words, in the case of an investment project, we should pursue it, right? Because it's It's even better than required for that level of risk. All right, so we to this point have talked about firms being all equity, but what if a firm is also issuing debt? In that case, the balance sheet of assets is equal to both the outstanding value of equity and the outstanding value of debt. That's the number of shares times the share price at any given time. That's the market value of equity. And similarly, the market value of the bond times how many outstanding bonds there are. So these are indications of market value. Together, what the firm owns is what it owes to its investors. So here you have the value of the market value of assets of the firm. So we have some symbols. I'm going to go through these symbols and a storyline to tell you that we began with an all equity firm, and I used S to denote shareholders or stockholders or stock value. But a firm can also be a levered firm. In other words, levered refers to the fact that they also issue debt. Now, there is somewhat tension between shareholders and bondholders, but it's justified, and we're going to get through all of that discussion today. It's justified and irrational. There is a rationale for taking on debt. So here we have just some symbols, right? We have here S is the market value of outstanding stock, where RS is the return on equity or the cost of equity. Beta S is the systematic risk of equity. So these are measures of return and risk for stock. And then we have the comparable risk and return measures for debt. This is the return of bonds, or cost of debt it's called. And the beta of debt is known as the systematic risk of debt. And together, these create the value or market value of assets of the firm. So you can be a stockholder. So from the perspective of investors, you can be a stockholder, you can be a bondholder, or you can be a mix of both. When I refer to, you can be partly stockholder, partly bondholder. But when I refer to the firm and return to investors in the firm, I'm going to refer to the average investor. And the average investor is an individual who invests in both stocks and bonds, but does it so in the same proportion as the firm is financed. Okay, so you'll see what I mean with that. Just double checking there's not another slide. Okay, this is my single slide set of notes. All right, so we have an all equity firm. The share of stock in a 100% equity firm is going to be 100%, right? Because there's no debt. Debt is zero, so it's just S over S, which is 100%. And the share that is debt for an all debt firm, so there could be a firm that just issues bonds, and in that case, it's 100% debt and no equity. But in general, we have a levered firm that is part debt and equity that are non-zero in both cases. And these are the weights, the relative weights of debt and equity. So just reiterating some of the terminology here. So in fact, our assets is the return to the average investor in the firm. So if the firm is all equity, our assets is just the return to equity or the cost of equity. Our assets for a firm that's 100% debt would be the same as the return or cost of debt. So this is just the interest rate. This is the yield to maturity um, on um, on the bonds that were issued. And a firm that is both equity and debt, we refer to this as the cost of capital because it has both equity and debt. And to be more generalizable, we refer to it as cost of capital. And R of assets is known as the required rate of return of the average investor in the levered firm, or in other words, the weighted average cost of capital. That's what WACC stands for. All right, so what is this all about? So what's going to happen next? We estimated CAPM with different inputs. First, we did it with the 6 years of the T-bill returns. The second round was to use more data of the T-bill, so historical data going back 80 years. Then we did the dividend growth model, right? And we settled on just using, because the dividend growth model result was similar to the first estimate, we just stuck with that 5.27 expected return and evaluated UAR's decision to invest in the Bahamas project. But what if I tell you that UAir also issues debt? So all these details are available in the case, part 2, UAir, UAir case part 2. And it turns out that UAir is also debt issuing firm, so it has equity and debt. In that case, we have to create the weighted average cost of capital. This is what we pay for every dollar invested. This is the expected return to the average investor in the firm. Remembering this formula, this is the equivalent of the expected return on a portfolio, right? Is X1 ER1 plus X2 ER2. Remember that. So that's all this is. There's nothing new here. I just got rid of the capitals and the E's. I just use R1. Kind of as a notation that gets used, but it's the same idea. But don't forget, where these come from, all the work we did to calculate those. So we don't have n assets, we just have 2. The firm has 2. They have stock and equity. Sorry, they have stock and they have bonds. And so here are actually the weights. This is the weight. Unfortunately, I put it after. It's so big and messy, it comes after. And here's the weight for that, for bonds. And here is the return to stockholders. This is the return to bonds. So at the same time, this is the return to stockholder. This is what gets paid for every dollar invested. This is what the firm owes the stockholder, expected to owe them. And this is the interest payment that is owed to bondholders. Now, what is this extra term? What is this extra term about? Anybody know? Comments? Oh, for every dollar invested by bondholders, the firm will pay them RB, but then, and this is the this is the Benefits of issuing debt is that interest payments are tax deductible. As a result, it turns out that issuing debt generates tax savings. So you remember we were using for depreciation, it realized a cash flow, right? And we were using their TCD. Remember that? We were calculating the tax savings or tax shields for depreciation. We're going to do the same thing here. So that's shown, that's demonstrated over here that, make that a little bit smaller. For every dollar invested, this is paid out, but then this is saved. So this offsets what we owe to bondholders, just like this did here, TCD, now it's TCRB. And this is where this term comes from, okay? And I explain it here. So this actually is, because TC is always a number between 0 and 1, this is always going to be a fraction. So this is going to be even smaller. So shareholders, as owners in the firm, they welcome debt, but only to a point, all right? And the next unit, Unit 6, discusses that. What is the optimal level of debt according to theory, using some assumptions and abstractions in the model of Modigliani and Miller. And I encourage you to study that. Although, like I said, it's going to be optional on the exam, but I encourage you to learn that material. You're going to need it for your future finance classes. Okay. So, that's what that term is here. All right. So now let's apply this to calculate the CAPM, or sorry, to calculate the return to investors in UAIR, but if it was leveraged according to what was explained in the case. Before I go to that, this is just one comment about the weighted beta. So you can do this calculation. This is a weighted average. For a portfolio that's made up of 2 or more assets, we have the weighted beta calculation. This will put us back on the line, right? If there's 2 assets on the SML, you can end up with a portfolio also on the SML in between those 2 assets. And this is just to point out that the beta of equity is going to be higher than the beta of the assets overall. So that the debt brings down the riskiness of debt, because it's lower than equity, brings down the average. And this is just making a point here that the debt, sorry, the risk associated with stock is high relative to the risk associated with debt, which we would say is closer to 0, okay, relative to the stock. So if that's the case, let's just make it 0. This falls out, and this is what remains. And rearranging this is just demonstrating that the debt of equity is going to be more than the debt of assets. So again, just think about it like this picture that we talked about here, where you have A and B is more risky than A, and in between is this one is somewhere in between. The riskier one still remains higher than the mix. So that's kind of what we're saying. This is like your RS, this is your RB, and this is the whack in between. That's what's going to happen. Oops, I went too far. I went too far. Now it's reloading. Oh, I broke it. It's probably just did an update. Okay. Are you guys with me? We're going to calculate now. We're going to do this a few more times. This is information. This question here, question 3, is on the UR case part 2, and I give you a bunch of information. I tell you what the portion of equity is and what the portion of debt is. So these are all given. And this is 53% equity, and the value is 47% debt. This number we calculated before, the first instance with using the T-bills of the last 6 years. And then this is also given. So this is given. So these are bonds that are issued with a yield to maturity of 6.04%, and the tax rate, corporate tax rate, is 40%. All that's given. You just have to make the calculation. When you put it together, you get a number that's in between, like smaller than the 5.27, just like I described, because the WACC is in between these two. So this is even lower. So are we going to accept the project? Well, if we did at 10%, so remembering the original was in part one, it was 10%. And then it went down to 5.27%. And then including the debt, it goes down to 4.5%. If we accepted it at 10%, we're going to accept it at 4%. Remember, the IRR was 10.26% for those cash flows. So we are going to continue to invest in the UR project. You have to look at the comments that I make. Do I ask you to calculate the NPV or to just test if or validate or verify if you should invest in the project? You can use the IRR, you can use the NPV. If I don't specify, you have to use one or the other. Okay, any questions about this? All those details are given in the case. Nope. No comments? All right. So, okay, so the last thing here to discuss, I think that's it. A couple more things. And then we can do some problems. We have like half an hour left. So, we assumed that the Bahamas project was as risky, sensitive, to market returns as UAIR's operations in general, but that's not necessarily the case. Let's say you're a manufacturing company and you decide to do deliveries, for some, so this is your project, is you're going to start doing deliveries for large orders. You're not going to hire a company, you're going to do it yourself. So now that's a whole other industry, right? That you're competing with. And maybe you shouldn't use the beta of your manufacturing firm. Maybe you have to go into identifying the industry beta for logistics or transportation and that's great if there's an industry, but what if you're a startup and nobody's even done what you're doing? How do you find a beta to use in your estimates? So these are all challenges. And I'm demonstrating to you that, you really need to think this through. And you could have many estimates. The point is that as long as they're similar, you're in the ballpark. And so far with everything we've done, we've pretty much justified investing in the Bahamas project. But let's say we think that the beta of the Bahamas line is actually 5.5. So this is gonna change our decision. So this is like a threshold. Like this is gonna change things for us. At 5.5, which is very high, that's 5 times what it was before, or more than 4 times. using the same numbers we had for the 5.27 measure, we have here the current T-bill rate. We have now the 5.5 for the beta, and we refer to it as beta of Bahamas, not just beta of UAir. And then using the historical market risk premium, average historical market risk premium of the last 6 years of data, we get 16.28%. We're not done because remember, UAir happens to be a debt issuing firm. So we need to combine this, get the WACC, and doing the math, you guys can check all these details later. You get 10.32%. So now 332%. So we see that if a beta is as high, if the Bahamas line beta is as high as 5.5, we no longer accept the UAir project. This number, if you remember, the cash flows didn't change. We're going to stick with those. And the IRR of the cash flows was 10.26. Suddenly, our project doesn't exceed the required rate of return. We would reject the UAir project in this case. All right. Any questions for me? And I just do this here. I just made a point here since from 2010, after the global financial crisis, T-bill rates were really low, like point 0 or point 0.1. They were very low, and that was in hopes of stimulating the economy, right? They were kept relatively low. So what do I mean stimulate the economy? Remember, decisions are being made based on the required rate of return. How did we estimate the required rate of return? But use this formula here. And the T-bill is right here. If you keep this low, then all other things staying relatively constant, then this stays low, the required rate of return stays low. And when that's low, you don't need much to beat it, right? If it's low, you're going to accept a lot of projects that you otherwise wouldn't. So that was my point of making that statement here. So monetary policy can effectively incentivize or stimulate investment, and that can result in an expansionary economy. I'm not going to say anything about it being good or bad at this moment, but that's, you can see, that's a consequence, or that's why that might happen. Okay, the last slide is this one. And I have an exercise where you practice this. What if a firm issues common stock, preferred stock, and bonds? Then the weighted average cost of capital needs to incorporate all three. Now, common stock, these are all expected returns, right? And we say that even though, you hold stock in a company, you're not guaranteed a dividend or you're not guaranteed a return. You are if you hold debt. You are promised, and shareholders are residual claimants after bondholders are paid. Well, after bondholders, preferred stockholders can have a commitment to be paid a return. That's different from common stockholders, but there's a trade-off because often preferred stockholders don't get to vote during meetings, stockholder meetings. So I just want to introduce that here, that there could be other assets issued or other financing instruments. And as a consequence, we have to put them all into our calculation where V is equal to the market value of all securities, stocks, bonds, and preferred. stock. Okay. All right, so that's that. So let's see, we have 15 minutes. Let's do some problems. You guys tell me which one you want me to do. Let's work like that because if I ramble on, I might not hit the mark. Let's look together here. Okay, I'm going to share. You guys are going to tell me where you want me to go. Okay, any problems you want me to do, or you want me to work on the old exam? Okay, here's a problem. This is review 4, Roman numeral 4. Now you can watch the solution, but it's not going to make sense, right? If you don't know what you're doing. So let's try and do this together. Let's start with the so we have them divided. I gave you the formula. Maybe I won't even give you the formula. You have to do this yourself. So you need to remember what we're doing. I'm showing this. My bad. Okay. So let's read for debt. I'm going to make it big for a second. We need to find the B and we need RB. We see TC is 50%. Okay. So let's read as much as we can about debt. Let's see what there is here to tell us. Okay, has long-term debt with book value of 736 million. So that's the book value. Let's write it down. But remember, I kept talking about market value. So let's be careful how we use this figure. We can highlight it maybe. Let's highlight it. So let's do that. Let's highlight yellow for debt. And then preferred stock with book value. We'll skip that for now. Book value. Okay, the interest on its debt. So this is also about debt. The interest on its debt is $72 million per year with annual payments. And debt is currently worth this amount per $1,000 bond. Oh my goodness. What do we do with all this information? I want the value of debt and I want the return. Do we have either of those? So I need, I want B and I want RB. Do we have that? Do we have either of those guys? I've highlighted in yellow. So the book value of debt is 736 million. Well, I'll just put an M. And the face value of each bond is how much? Remember I told you it's either 1,000 or 5,000. What does it look like here? It's $1,000. Okay. So what does that tell me? How many bonds are outstanding if this is true? So um in our books, right, the book value is 736 million at $1,000 face value apiece. So that means that how many bonds are there? Anybody got it? So like this, I'm gonna erase this after, but so this is actually like the number of bonds times $1,000 each. That's the book value. So that means the number of bonds is 736 million divided by 100,000, or there are 736,000 bonds. Okay, so we have the number of bonds. Now we just have to find the price of the bond to get B. But to find the price of the bond, oh, we have the price of the bond. There it is. It's currently worth 834.18, so that's great. So we can get the market value. So market value is equal to number of bonds times price per bond. So it's 736 times price per bond, 834. I hope this is right. I'm gonna double check. I'm pretty sure it's right. And that's your market value. Now you have that. So that's B. Are you guys there? So how much is B? It's 613,956,000. No, $956,480. Okay. And then RB. How do we find RB? Well, we have some information here. RB can be computed using all the information. So let's set it up. Let's set up for a bond. It's 83418 is the price, and that's equal to the annuity. It's a coupon bond, right? Interesting. $72 per million. Um, Okay, you're told about the coupon. You're told about the interest payments in total. Okay, so there's annual payments, not semi-annual. And the interest is about $72 million per year. So if we were to write this equation, we would need the payment. The interest rate is what we want, right? We want the yield to maturity. And then we need this. So this is the formula, but we're missing how many years? 20 years. Okay, so that's the formula, but we're missing two things, the payment and the RB, the cost of debt, the yield to maturity. So we got to get the payment from the other information given. And you're going to figure that out by the fact that you have 72 million per year in interest payments. In other words, these are your coupons. Out of the total book value, which is 736 million, and that's going to give you your coupon rate. So the coupon rate is the 72 million. I'm just going to use an M. Divided by the total book value. And you figure out that the rate is 0.09783. So that works out to be a payment is C times F, remember? And there's no dividing by 2 because these are annual coupons. So C is this number 0.09783, and times F is 1,000, remember? And this is $97.83. So that's what's going to go into the payment here. So put that in with this payment. Can you do it without me? Or I have to do it? Do I have to do it? Let's get my calculator. So we're going to put in the calculator 20 years. Interest is what I want. I'm going to put the present value of $834.18. And then the payment is going to be positive 97.83. And the face value is 1,000. And I'm going to compute. There you go. So I should keep all those decimal places. To get the same answer as me, you need to keep everything. The only things you round ever are like dollars and cents, like I had to round to make the payment here. And like mortgage payments, those are rounded. But otherwise, don't round these decimals for interest rates. So this is RB. Oops. Just store it in one. I might need that. I will need it. Okay. Any questions so far? So that's all my information for debt. Can you guys try and do equity without me? So we have B, which was this one, and RB is this one. Next is to extract the information on, we can do, what did I do here? Preferred shares, okay. So preferred shares, what do they say? We'll use a green highlighter. Okay, preferred shares, 1 million shares with book value of 100 million. And then preferred shares are presently selling for $85 per share and pay a constant dividend of $6 per share. Is that it? Okay. So again, we're going to need P or SP and RP. Okay, good. Okay, so how are we going to get SP and RP? So let me take all of this and move it. I'm going to put it somewhere. Another page. Okay, so we're going with the green. So now we need we want the market value of preferred, oops, I need black. The market value of preferred stock, and we want the RP, the return, the cost of equity for preferred stock. All right, so we have in green that the book value, okay, there's 1 million shares, that's helpful. So number of shares is equal to 1 million with a book value of 100 million. And common equity, we're going to skip that for now. Preferred shares are selling for $85 per share. And they pay a constant dividend of $6 per share. How do I use that information? Where should I start? All I need, well, I have the price. Market value can be calculated by price and number of shares. Do I have those? Yes, I do. So I can calculate SP very easily. Right? So it's $85 million. Got it. And then what about RP? All right, so what do we do? So please tell me you know how to do this. How do I figure that out? I have the price and I have the constant dividend. You see the assumption or the imposition there? What do you do with that? I'm going to give you a minute to think about it. Make me proud. You're not going to make me proud? Come on, guys. What is a basic pricing model for stock? PV0 equals C1 over I. Or in our case, $85 equals 6 over RP, you see? So RP is equal to 6 divided by 85. That's it. So it's 7%. 7.0588235%. Got it? We're done. That was easy. It's just really messy. Just kind of messy. You got to practice it just to see that it's not a big deal. It's a lot of computations, but it's pretty basic application of what you already know. Just we have to do it 3 times because we have 3 securities. Okay, so we've done that. I have SP. Oh my goodness, I want to get rid of this. So SP and RP. Got it again, Kiara? I hope so. Can you guys do common stock without me? So the assumption here, I mean, the unsaid assumption, not assumption, but it tells you it's a constant dividend, $6. That's how I know to do that. If it says constant growth, then that's the dividend growth model. Okay, let's put that away. Oops, I keep leaving. I don't need to leave. Here, let's clean it up. All right, let's do the last common stock. Oops, what did I do? That's that one. Okay, let's do blue for common stock. Okay, so common equity, 44 million shares with book value of 1,421 million. In other words, 1,421,000,000. Common shares paid a dividend this year and sell for $30 per share. The common dividend is expected to grow constant rate of 5%. There you go. So all the blue. Can I give you a minute to try that without me? Give you a minute. Did you do anything without me? 5 minutes left. Let's see. So this is even easier. You're given the number of shares, so 44 million shares. And the price, we need the price for the market value. But let's see if we can get this first. We don't have the price, right? We have, they paid a dividend of $4 per share this year and sell for $32 per share. There you go. So that's $32 per share. So you can calculate that market value. And then using the rest of the information, you have, you can solve for using the dividend growth model or the growing perpetuity formula. I equals C1 over PV0 plus G. So the current price, but next period's dividend. So if they're growing at 5% and the dividend this year was $4, the next period dividend will be with the $32 price plus the growth, and that's going to be RC, right? So remember, we're estimating now, we're using this symbol for the expected return or the cost of equity. So when you do that, you get that the rate is 18.125%. And the market value over here is 1,408,000. Nope, 1,408,000,000. Sorry. And then you got to put it all together, which I don't have time to do. You put it all in the whack. So all those pieces of information, the market value and the cost of equity and the cost of debt and the tax rate go together to get the final answer. So the challenging part was dissecting and getting market value and the cost of capital for each of them. Okay, guys, I'm going to say goodbye unless you have a question for me. If you want to meet with me later today, Alana said at 8 o'clock maybe she's going to contact me. So that's in a few hours, but just text me and I'll meet you back on Zoom. If anybody wants to participate, you're welcome.
Excuse me.
Uh-huh.
My name is Sebastian.
Hi, Sebastian.
Hi, how are you, Teresa?
I'm okay.
Okay. I was wondering, the assignment of the how of Bloomberg, the one that that we did the certifications and we had the other assignment.
Oh, the other assignment. I forgot about that assignment.
Yeah, we got to do that. The four
No, don't
point.
worry.
No. Okay,
You don't
okay,
have to
okay.
do that.
I thank God. Yeah.
Did you start?
Thank
Did
you.
you do it or
No, no, I
was it
only did the
clear?
certifications. Oh,
Oh,
bless
sorry. I
you.
haven't heard from anybody about that. I forgot about it. My goodness.
Yeah, no, no, you're
Yeah, there's no
good.
next week, like we're not meeting next week because the test is going to be 3 hours. So that takes up next week classes. We don't have to meet. But for people who need another test because they don't have enough tests or they don't have enough good grades on tests, we can talk about giving them a chance. I have to look back at the Bloomberg assignment and I wanted you guys to solve that problem. I think it was a whack problem. But I'll look at it anyways. If somebody needs an assignment, maybe I'll give them that. If you
Okay,
need a
okay, thank
test, if
you.
somebody needs another test, I can give them that. That'll
Okay,
make
thank
it
you.
easier for me.
And I had another question. The final exam is in Osuna 222, right?
222, yeah.
Okay,
Or six
thank you.
o'clock on Friday.
6 o'clock, okay.
Okay, and I'm available tonight and tomorrow virtual if you have any questions. Okay. Have a good afternoon, everybody. Good luck. Study, study.
Thank you, you too, Professor. Have a great night.
Bye.
Bye bye.